Welcome to another episode of Financial Insights in Minutes. We help you save time by summarizing today's top financial news videos. Today, we're diving into some chilling economic insights, including recession fears and stock market declines.
We'll unpack warnings from experts on rising unemployment and what that means for investments both now and in the future.
And don't miss our exciting outrow, where we'll summarize the experts' thoughts and the clarity and confusion in their messages. First up, Eurodollar University's Jeff Snyder reveals stark truths about the current recession. Next, Danielle DiMartino Booth joins Neil Cavuto as they analyze the stock market's turbulent response to new job reports. Claudia Sahm discusses the crucial implications of her S rule and the potential recession risks it suggests. Bianco shares insights on rising unemployment and the Federal Reserve's conundrum in today's economy. Trade Brigade prepares investors for a market shakeup amid unsettling labor report revelations. Finally, Shapiro prompts traders to stretch their focus beyond conventional stocks for better opportunities. Ahoy there! Welcome aboard to Eurodollar University's channel. Today's hot topic is the recession finally here. And we're navigating these stormy waters with our trusty expert Jeff Snyder, who has his finger on the economic pulse.
Right you are. Jeff dives deeply into the triangles of treasuries, swaps, and more, drawing conclusions that could shake the market. With his robust background in macroeconomic analysis, he's got the expertise to back it up, so stay tuned.
So what's the crux of Jeff Snyder's discussion? What's the ship's main point?
The core thesis is sounding alarm bells. The labor market data confirms that we're transitioning from a soft recession to a full-blown economic downturn. Markets are revealing it loud and clear.
Let's break down those critical indicators. How's the labor market playing into this?
Well, typically we're reacting to the news, but this time the news is confirming what was already a part of the narrative. Friday's data showed sharp increases in unemployment, acting as a final confirmation of recession.
And what about the Treasury yields? What do they signal?
The yield curve is undergoing a dramatic bull steepening. The 2-year Treasury has dropped to 3.89%. It's like a roller coaster, but one with some serious downturns ahead.
And as for interest rates, what's the lowdown there?
The market is pricing in aggressive rate cuts soon. SOAR futures indicate potential cuts as early as late 2024. It feels like a financial roller coaster ride that nobody asked for.
It's not just localized trouble. What's happening globally?
Exactly. The signs point to a synchronized global recession with rates falling everywhere from the US to Germany to Japan. It looks like we're on a shared sinking ship.
Time for some crystal ball gazing. What's next for interest rates?
We're likely to see some aggressive cuts as the Fed responds to rising unemployment. Once rates start to drop, they're expected to stay down for a considerable stretch, shaping the economic landscape.
And what do we predict for the recession itself?
We might be in for a mild recession with a prolonged jobless recovery, which isn't pretty. But more severe outcomes are possible, leading to further monetary easing. It's as if we're stuck in a financial storm.
So what's the final word?
In short, all signs point to a confirmed recession with serious implications. It's time to buckle up and prepare for these economic waves ahead.
Welcome aboard. Today, we're diving into the turbulent waters of the stock market following a recent jobs report that has raised recession alarms. Joining us for this analysis is Neil Cavuto from Fox Business Network. Hold on tight, folks.
Indeed. Neil brings a wealth of expertise to the table analyzing today's market turmoil and its implications. Let's get straight to the facts.
So, what's the main takeaway from this chaos in the markets?
The key thesis? Recent declines in the stock market signal increased recession fears, primarily driven by weak job creation in the private sector.
Let's break down those key points. What's this market decline telling us?
The Dow Jones plummeted nearly 1,200 points, while the Nasdaq has officially entered correction territory at down 10%. That's no small dip.
What about the Federal Reserve? What's their role in this mess?
There's massive pressure for substantial interest rate cuts. However, it's critical to note that the Fed cannot single-handedly reverse the economic slowdown due to deep-rooted issues.
And what's going on with job creation?
The weak job creation reflects serious issues. Companies like Intel are cutting nearly 20,000 jobs even after receiving $8.5 billion in federal funding. Talk about irony.
So looking ahead, what predictions are surfacing?
We can expect rising bankruptcies, especially among small businesses, which have surged 60% year over year. This trend could impact larger companies soon.
And what about interest rate trends?
Interest rates may continue to drop, leading investors to consider fixed income securities. Boring can be profitable here.
To wrap things up, what lessons should we take away from today's discussion?
The challenges in job creation indicate deeper economic issues ahead. Investors must be cautious about the current atmosphere and shift strategies as needed. It's a turbulent ride.
Any last thoughts on what lies ahead?
The recent market declines should spur discussions on alternative economic solutions, not just bailouts. The ocean's getting stormy, folks.
Welcome to Thoughtful Money. Today we're diving into a serious topic: the latest triggers for recession indicators, specifically Claudia Sahm's S-Rule. Joining us is the brilliant Claudia, a renowned economist with a rich background at the Federal Reserve and the White House's Council of Economic Advisors.
That's right. Claudia's insights are crucial as she explains how the S-Rule functions as an early warning system for recession risks. You won't want to miss this exploration into the economic landscape.
What's the key message from Claudia's discussion? Why does the S-Rule matter right now?
The main thesis here is that the S-Rule recently triggered for the first time since the COVID-19 crisis, reflecting rising unemployment and potential recession. A warning bell that needs our attention.
Let's break down the significant points about the S-Rule.
First, the S-Rule measures unemployment rate changes to predict the onset of recession, emphasizing that government should act promptly with fiscal responses.
What's going on with the current economy amid this cooling labor market?
Despite inflation nudging down, Claudia argues that we're still at risk with a cooling labor market, which could exacerbate unemployment and trigger a recession.
How should policymakers approach these warning signs?
Claudia advocates for ready-to-deploy fiscal policies, but there are concerns about prematurely labeling an economic downturn.
So based on Claudia's insights, what are the predictions moving forward?
Claudia predicts that if the labor market continues to show signs of weakening, it may lead us directly into a recession unless effective fiscal measures are taken quickly.
To wrap it up, what's the big takeaway today?
Claudia calls for urgent attention to the S-Rule. Policymakers must act decisively to mitigate risks before they escalate into a full-blown recession.
Welcome to the channel. Today's topic: the surprising surge in unemployment and what it means for the economy, with special insights from Jim Bianco, president of Bianco Research. Get ready for some insightful market analysis.
Absolutely, Jim, with his extensive background in financial research, will provide an enlightening perspective on the Federal Reserve's policies and their impacts on the labor market and economy at large. Buckle up.
So what's the big takeaway from Jim Bianco's insights?
Jim posits that while the unemployment rate is creeping up, it may reflect demographic changes, particularly due to immigration, rather than a faltering economy.
What about the current state of the economy?
The unemployment rate currently sits at 4.1%. And while that seems alarming, the job creation figures show a steady increase of 177,000 jobs each month.
What's the outlook for the Fed?
Many markets predict an 81% chance for a 25 basis point cut this September, but cutting rates could potentially reignite inflation, which Jim argues would be a mistake.
And how do demographic changes come into play?
Jim highlights that the rising unemployment rate is heavily influenced by an influx of immigrants, which impacts the job market by increasing the number of unemployed relative to available jobs.
What predictions does Jim make for the Fed's future actions?
If negative economic data emerges, further rate cuts may occur. But with a resilient job market, the Fed might choose to maintain the current rates.
And inflation, what's Jim's stance?
Jim suggests that cutting rates could lead to an increase in inflation, which might stay elevated at around 3 to 4% over time.
So in summary, what do we take away from Jim's insights?
It's crucial to view the rising unemployment rate through the lens of changing demographics rather than solely economic decline. Moreover, the Fed's actions will likely play a pivotal role in shaping future inflation and economic stability.
Welcome to Trade Brigade. Today we're diving deep into the murky waters of the stock market. What do Friday's labor report and numerous risk-off signs mean for investors? Strap in, because this journey might not have a happy ending.
Absolutely. We'll break down the stark realities of a market that's crying for attention. With a labor report that hinted at disaster, it's crucial to analyze where the tides are really turning.
So what's the crux of today's discussion? Where do we stand with the market?
The core thesis is simple. The labor market is showing signs of distress. With a disastrous report on top of a looming recession, the environment is less than favorable for investors looking for stable growth.
Let's unpack those key points. Starting with the labor report, what happened there?
The non-farm payroll showed a surprising gain of 114,000 jobs. But that's still a miss. The unemployment rate isn't providing any comfort either. It signals potential trouble ahead.
And technically, how does the market stack up?
We're seeing bearish indicators on the charts, especially with Fibonacci levels suggesting we could see deeper pullbacks. Overall, the trend isn't in the bulls' favor.
What about the sectors? Any signs of hope?
It's all risk-off. Defensive sectors like utilities and healthcare are outperforming while investors flee to safety, showing a reluctance to commit to riskier assets amidst the uncertainty.
Time for predictions. What lies ahead for the market?
Expect continued decline. Weak earnings and the looming threat of a recession mean that the bearish trend could persist. It might take more than a miracle to turn this ship around.
To wrap things up, what's the takeaway here?
The key is to keep a close eye on labor market data and economic indicators. A conservative approach might just save you from financial turbulence. Stay vigilant out there.
Welcome to Crowded Market Report. Today we're embarking on a thrilling journey into the world of trading beyond just stocks.
That's right. Jason Shapiro stresses the importance of expanding our trading horizons to include a variety of assets. His extensive experience adds reliability to this discourse.
So what's the crux of Jason's message today?
The core thesis is all about flexibility. Traders should not fixate solely on stocks, but instead explore a broad spectrum of assets. This strategy helps catch movements that may go unnoticed if one only focuses on headlines.
Let's break down those key points. What can we learn from past market movements?
In 2008, while the stock market plummeted by 55%, commodities like unleaded gas saw an even steeper fall of 75%. Diversifying focus can unveil hidden opportunities.
And what about those crowded trades? What's the scoop?
Jason points out that markets like copper provided chances to profit when they were crowded trades, often outperforming declining stock markets. For example, the Swiss franc showed signs of a risk-off environment before stocks began to falter.
Interesting. How does this apply to stocks themselves?
Exactly. It's crucial to diversify even within stocks. Take SMCI, which began to decline well before the broader market topped. Identifying weak stocks can be just as valuable.
What predictions did Jason outline for future trading strategies?
He predicts that traders should remain adaptable, paying attention to macroeconomic themes rather than solely focusing on specific stocks. This approach can lead to better trading outcomes during volatility.
To wrap it up, what are the key takeaways from today's discussion?
Jason reiterates the value of diversifying across various asset classes and themes. It's not just about stocks. Traders can capitalize on moves across commodities and currencies. Keep your eyes peeled for every opportunity.
What's the overall advice moving forward?
Stay informed, be flexible, and navigate the currents of the market wisely. Trading isn't just about the headlines, it's about the opportunities underneath.
In conclusion, we've gathered insights from several experts on the current economic climate.
There's a consensus on the threat of recession, yet disagreement on its causes, especially regarding unemployment.
Understanding these perspectives is essential to navigating these turbulent times. Thank you for tuning in to Financial Insights in Minutes. Thanks for watching Financial Insights in Minutes for August 4th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.